Good morning, everyone. We can start today's webinar, by the way. So the webinar for today will be made in such a way that starting, I'll be discussing on the recent market updates, by the way, what's going on, the currency stuff, inflation stuff, and how apart from Indian market, how the global market look in growth, also regarding the recent crude oil stuff and so later we can see how to approach this, followed by how we can help you to reach the particular your goal through this changing dynamic market environment, right? Yes, let's start first. So when we talk about this market changing, we need to first understand that the macroeconomic backdrop that is shaping investment sentiment globally. Okay. Over the last few months, one of the key concerns that has emerged the possibility of the stagflationary environment across several major economies. So, as stagflation is the situation where economic growth slows down while inflation remains more elevated, right? So if you look at the table on the left, Bloomberg's expectation for 2026 have undergone a noticeable revision. So across many developed economies such as the US, Euro, and the UK, growth expectations have been revised downward, while inflation expectations have moved higher. So this combination is never ideal because it limits the flexibility of the central banks. If inflation remains high, policymaker cannot aggressively cut interest rate to support the growth, which creates uncertainty for both business and investors, right? One of the major driver behind this inflation concern is energy. The chart on the right shows that despite this, some moderation from peak level, Brent crude and the LNG futures continue to indicate elevated energy cost looking ahead, right? So recent geopolitical development with the US and Iran, particularly the tensions across the Middle East, have added another layer of uncertainty to the energy market. Higher energy prices eventually feed into transportation costs, manufacturing costs, and overall inflation across these economies. So this is why global markets are becoming increasingly more sensitive to this every development in this geopolitical front. However, while these are important risks to monitor, it is equally important not to extrapolate global concerns directly onto like India, I would say. India's position today is fundamentally different from many developed countries. See, if you look carefully at the data, India's growth expectation revision remains among the strongest global at around 7.5%. Even after this recent revision, which takes place of the other developed countries, that itself highlights the resilience of our Indian economy. So this structural driver that have supported India's growth story over the last decade remain even in intact, I would say. Even domestic consumption continues to be robust. Government-led infrastructure spending remains strong. Manufacturing investment are increasingly more right now, and the financial sector is significantly healthier than it was a few years ago, like 2017 NPA crisis and so. In addition to this, India benefits from a large domestic demand base, which makes our economy less dependent on external demand compared to several export-oriented economies, particularly China. So, corporate balance sheet are stronger, banks are well capitalized, and household financial savings continue to move towards what I would say, like more financialized kind of assets. So these are kind of a long-term structural positives that should not be ignored simply because the global environment is becoming more challenging. So investors should recognize that a strong long-term growth story does not automatically translate into a smooth investment journey. Yes, even within a growing economy, different asset classes perform differently. Depending on the macro cycle, there can be a period when equities lead, where even fixed income become attractive and not so, and periods when assets such as gold act as an important stabilizer. The challenge for investors today is not predicting every macro event correctly, but ensuring that their portfolio is prepared for these multiple outcomes. So, see, while global growth concerns and inflation risks are kind of certainly rising, I would view them as more a reason for a better portfolio construction rather than a reason to become more pessimistic about India. India growth story remains very much alive, but the path forward is likely to be more dynamic and more volatile than what investors have experienced a few years back. And that is kind of precisely why investment strategy becomes just as important as investment conviction in the current market environment. Uh, Now building on to the previous discussion around the inflation risk, let's look at how rising energy prices are beginning to reshape global interest rate expectations. For a much kind of For much of this last year, market were expecting central banks around the world to gradually move towards lower interest rate. Right. Right now, the assumption was simple. Growth was the reason why they were tending towards a lower growth cycle is growth was moderating, inflation was coming under control, and monetary policy could slow become more supportive. However, recent development have started challenging that narrative. As the energy prices move higher, inflation concerns have resurfaced, and that has forced investors to reassess the path of interest rate globally. If you look at the table on the left, market expectations suggest that many economists may eventually see a stable to higher policy rate over the next 6 to 12 months. So this reflects that the reality that central banks remain cautious. When inflation risk risk is getting increased, policymakers generally prefer to wait and assess the situation rather than rush into a rate cut. Every kind of see the energy inflation is particularly important because it kind of affects almost every part of the economy. First, transportation, manufacturing, logistics, utilities, and even consumer spending patterns. So, therefore, even if a core inflation appears manageable, this persistent energy inflation can keep overall inflation elevated for a longer than expected time zone. Then the chart on the right highlights perhaps the most important shift in the global expectation. The US Federal Reserve earlier a market were pricing in a meaningful rate cut cycle beginning in 2026. However, when you see as inflation concerns have resurfaced, those expectations have changed significantly. See, instead of aggressive rate cut, market now expect the Federal Reserve to remain cautious and potentially keep rate higher for longer time, I would say. This is a major shift because US interest rate kind of influence global capital flows also. Bond deals, currency movements, and even investor sentiment across the markets worldwide. Whenever we discuss higher global interest rate, investors often become concerned about emerging markets, including India, if you see. But I think it is important to separate short-term market reaction for the long-term economic fundamental. India's economic position today is considerably stronger than in many previous globally tightening cycles. Our banking system is healthier, corporate balance sheet are stronger, even the foreign exchange reserve remains substantial, since we see some kind of this temporary issue in the deficit, but in long run it is still more vibrant, and the domestic consumption continues to provide a stronger growth. More importantly, see India's increasing its view on structural growth opportunity rather than just a cyclical emerging market trade, I would say. At the same time, this higher global interest rate can create a period of market volatility. Liquidity condition may be tightened, valuation multiples can fluctuate, and different sectors can react differently to the change in the rate expectation. This means every investor can rely solely on a single asset class or a static investment approach. No. In an environment where inflation, interest rate, energy prices, and geopolitical developments are all influencing markets simultaneously, portfolio flexibility becomes important, kind of more important, I would say. Another point worth noting is that while higher rates may create challenge for some part of the markets, they can also create opportunities. Fixed income instruments may become more attractive. Certain defensive sectors may outperform, and asset classes like gold can play an important role during the period of uncertainty. In other words, the changing macro condition do not necessarily mean lower investment opportunity. Then they simply mean that the leadership within the portfolios may change over time. So the key thing you want to understand is that like investors should be worried about the rising rate. No, I would say. But rather than the global investment environment is becoming more dynamic, you should look in that angle. The days when one asset class consistently outperformed everything else may not continue indefinitely. As market evolves, successful investing increasingly depend on this adapting to the changing condition, like this dynamic condition, rather than this making a single long-term macro prediction. And that naturally leads us towards discussing how investors can build a portfolio that are designed to navigate multiple market environment rather than depending on one just outcome. One of the another important interesting development is the current market environment is that the thing is that many of the traditional portfolio hedges that investors have relied upon for decades are not behaving the same way they normally do. Yes, historically, during the periods of the geopolitical uncertainty, investors would naturally move towards assets such as gold and silver, particularly gold, I would say, and government bonds for protection. However, the current environment is proving to be much more complex. Let's first look at gold. If you see the chart on the left, during the events such as this COVID and the Russia-Ukraine conflict, gold responded positively and acted as a traditional safe haven asset. However, if you see during the recent Middle East tension, gold has not provided the same level of protection that investors expected and has actually witnessed some correction from its peak level. This does not mean gold has lost its long-term relevance, but it highlights that even traditional defensive assets can experience period where the behavior differs from historical patterns. Now, let's look at bonds. Normally, when uncertainties rises, bond prices tend to move up and the yield move down as investors seek safety. But this time, higher oil prices are creating inflation concerns. As inflation expectations rise, bond yields have moved higher across many countries. As shown in the table on the right, even India has witnessed an increase in yields during this period. This tells us that inflation concerns are currently overpowering the traditional safe haven demand for bonds. The key message here is that market are no longer driven by a kind of a single factor. Growing something like growth concern, inflation risk, energy price, central bank action, then the main thing geopolitical development across all the interacting things. And this is very important. This everything is taking place simultaneously. As a result, relying on any one asset class as a permanent hedge may not be sufficient in the current environment. Now, this should not be interrupted as a negative development first. Instead, it is a reminder that even investing today requires a more dynamic approach. Different assets may perform different roles at different times. There may be phases when equities drive the returns, phases when fixed income becomes attractive and not, and phases when gold provides diversification benefits. The challenge is identifying which asset class is likely to add value under the prevailing market condition, rather than maintaining a static allocation irrespective of the challenging or this changing realities. For investors, market have become more interconnected and more dynamic than before. Traditional relationships between asset classes can temporarily break down, which is why portfolio flexibility and active asset allocation becomes increasingly important. Rather than betting on a single asset class, investors may benefit from an approach that has the ability to adapt as the market conditions evolve. That is dynamic. And that brings us close to understanding why this dynamic multi-asset strategy can be particularly relevant in today's market era. Okay, another important trend that investors need to pay attention is that the movement in global currencies, particularly the strength of the US dollar. As we discussed earlier, when uncertainties rises and interest rate remain elevated, global capital often move towards the US dollar because it is still considered the world's primary reserve currency and as a safe haven asset. As a result, we have seen the dollar index or the DXY strengthen recently as shown in the chart in the left. Now, whenever the dollar strengthens, it tends to create pressure on most global currencies. The chart on the right shows that most developed and emerging market currencies have experienced a varying degree of depreciation against the gold. This is not an India-specific phenomenon. It is the kind of a global trend that typically emerges whenever investors become more risk averse or when in US interest rate remains higher than expected. From an Indian from India perspective, currency movement are important because they influence our imported inflation, foreign capital flows, and corporate profitability in certain sectors. A weaker rupee can increase the cost of imports, especially commodities such as a crude, what we are experiencing right now, while at the same time benefiting things like export-oriented industries such as the IT services, pharma, and certain manufacturing segments. Therefore, the current currency depreciation is not necessarily entirely negative. Its impact depends on the broader economic context and the composition of the economy. So, what is encouraging for India in this fight of this global currency pressure is that our macroeconomic fundamentals remain relatively stable. India's kind of foreign exchange reserve remains healthy. The current account position is manageable, I would say, and the policymakers have demonstrated the ability to manage this currency volatility without creating a significant disruption in the financial system. Maybe there will be a kind of a short-term pressure, but in long term, still everything is in positive zone. As a result, while short-term this fluctuation in the rupee may occur, that kind of not fundamentally alter India's long-term growth trajectory. For investors, however, this currency movement add another layer of complexity to their portfolio management, I would say. A stronger dollar can influence equity valuation, then commodity prices, bond markets, and foreign investors' behavior. Kind of everything will be occurring the same time, by the way. So investment decisions cannot be based on a single variable alone, I would say. Instead, investors need to consider how multiple macro factors are interacting with each other. The broader message from this slide is that we are operating in the world where global events are increasingly interconnected. Energy prices, influence in inflation, then interest. See, it's something like you can keep in mind like this. Energy prices influence inflation, inflation influences the interest rate influences the currency. And all of these factors ultimately influence the asset return. Finally, it will affect your portfolio return. So you can keep in this particular flow. So in such an environment, maintaining flexibility within a portfolio becomes extremely important. See, rather than trying to predict every move in the currency or this global market, investor may be better served by adopting an investment approach that can adapt to changing macro condition while remaining focused on the long-term wealth creation. And that is exactly why we are again stating dynamic multi-asset framework becomes relevant in today's market environment. Yes, now we come to an important slide. So now, after discussing all the macro concerns, whether it's inflation or the interest rate stuff, geopolitical tensions, currency volatility, or the energy price, the most important question for investor is how should we approach all of this? Because if you look at the financial news every day, there is always something to worry about. Every year brings a new crisis, a new headline, or a new reason to stay on the sidelines. This chart, see, it beautifully captures that reality. If you look at the last four decades of the census journey, you will see that almost every major event that investors fear at the time is marked on this chart, by the way. We had the Gulf War, the political instability, the Harshad Mehta scam, the Asian financial crisis, the dot-com crash, the terrorist attack, the global financial crisis of 2008, then the demonetization, Brexit, COVID, the geopolitical kind of tension, then the trade war, the tariff issue. So at every point in time, investors believe that the current crisis was unique and that the market would struggle to recover. But what is interesting is not the events themselves. It is what happened for those see. If it is like what happened for those events, if you look beyond the short-term correction and focus on the long-term trend, the market continued to move higher over time. The temporary decline felt significant, but they occurred. But as we look back today, and many of those events appear as a smaller interruption within a much larger wealth creation journey. So the lesson here is not that the risks do not matter. It's like risk absolutely matters, I would say, but market will continue to react to them. However, history tells us that most events create short-term volatility rather than a permanent destruction for a long-term. But that's a lesson I want you to understand from here. So, see, in fact, some of the best investment opportunities often emerge when uncertainty it is uncertainty is in the kind of a peak or it's in the highest stage. When fear dominates headlines, valuation becomes attractive, sentiments become weak, and the quality asset can become available at a price that may not be available or can be seen during a normal normal investment period. As an investor, one of the biggest mistake we can make is allowing short-term noise to derail long-term goals. A retirement goal, a wealth creation goal, or a financial independence goal is typically a journey measured in kind of years and decades, not a week or a month's kind of a disruption what we are seeing. Yet many investors end up making decisions based on the short-term headlines rather than a long-term objective. They become overly optimistic when the market are strong and overly pessimistic when when the uncertainty is kind of rising. So what this chart reminds us is that the volatility is not an exception in the investment journey. It is a feature of investing. Market correction, geopolitical events, economic slowdown, and policy changes all are part of the journey. The objective is to avoid volatility completely because that is impossible, I would say. The objective is to build a portfolio that can navigate volatility while remaining aligned with your long-term goals. So, whenever we see events like rising oil prices, global inflation concern, currency fluctuation, or geopolitical tension, the first question should not be, should I stop investing? Rather, the question should be, does this change my long-term financial objective? In most cases, the answer is no. What may need to change is the way we allocate asset with the different strategy and manage the risk. But the destination remains kind of same for the throughout the your sustainable journey, I would say. And that is why successful investing is often less about predicting the next crisis or more about maintaining a discipline through the multiple market cycles. While the headlines change every year, one thing has remained remarkably consistent that the ability of quality assets in the strong economies to create wealth over the long term. The challenge is staying invested and staying adaptable enough to benefit from the long term growth journey. Um, so then we can now move towards the solution for the thing what you are seeing right now. So yes, now we can see the product Sphere, which is a dynamic multi-asset product. Well, so the strategy what Sphere as a portfolio follows is the dynamic multi-asset approach. So we do not follow anything like we have a kind of a model portfolio or something like we have a certain percentage cap that we should have this much in this asset class or this much in this asset class, and so we don't have anything like that. We follow the approach in a way that when the particular opportunities available in a particular asset class in a more favorable manner, we have good exposure towards them. When we find opportunities not good in any asset class, we will not participating in that. So we'll be more dynamic based on the market condition, how it's evolving. And to have a good, sustainable, ideal journey in product for your wealth creation, we have a professional portfolio management team where we follow more structured approach towards this wealth creation journey. And the important thing is that active risk management is our core philosophy, by the way. And when it comes to Spear, the as we discussed in our earlier slides, that the long-term wealth creation will be the main focus for us. Okay, now, so why Spear PMS is relevant today? As I stated earlier, due to this recent market sentiment, which is changing from inflation, from currency kind of depreciation, and the volatility what seeing in the market, the dynamic approach plays a key role during this market, and also the macro our investing framework. So we should know how to adapt to this changing macro environment. So this also being part of our Spear's philosophy. And of course, the diversified approach. So the correlation plays a key role when it comes towards the drawdown risk management. And yes, when we talk about Spear, the Spear is like all weather portfolio. When uncertainty is there throughout the market cycle, Spear is adaptable to everything towards reaching a long-term sustainable goal. So most of the things have been covered in my previous slides. So when it comes to the philosophy, once again, so asset allocation, so it provides a strategic distribution across various asset classes. So in a long run, it provides a better risk adjusted return. And as I stated earlier, this also reducing volatility. So risk management plays a key role. The risk management part plays a big role when the markets are not in a favorable zone or they are in a bearish zone. When the markets are moving upward, people are not kind of having a much concentration, or they are not going to care about what's about risk and so. But when the things are not in their favor, the volatility management, the risk control plays a key role in the portfolio journey. As we participate in different asset classes, we are able to capture the wider range of opportunity available in the financial universe. And as we are dynamically shifting from asset classes to capture the opportunity in various asset classes, your compounding power will be continuously being made up, and it will be kept still the particular journey of your wealth creation is built up. Then the investing style, what we follow in Sphere is contra investing as well as value investing. So we bet against the market trend, by the way. We seek opportunity which are out of the favor sector. And we more focused on the mispriced asset classes due to the overreaction. As when the markets have any bad news, we can see that certain good fundamental companies will also overreact. We participate in that and take cover position. And main thing is value investing will be our core, by the way. So we only invest in companies where the fundamentals are really strong. They should have a strong balance sheet with a strong future cash flows, by the way. And we also see the margin of safety as our main focus. And we follow the this also, we follow bottom up as well as top down approach simultaneously. It depends on the market sentiments. So when we follow anything like a particular theme, a macro theme, we follow more of a top down approach. When we see anything, something like a particular company, and so we follow more a bottom up approach as we study the company in a more due diligence manner. Then we see whether the particular company has a good journey towards the sustainable wealth creation towards the long-term horizon. When it comes to Spear, by the way, so we operate in the framework of moderate to conservative zone. Yeah, so I'll just here's a comparison between Spear and other multi-asset mutual funds, by the way. So when we look at multi-asset mutual funds, as what we have seen earlier, so they have a certain percentage as a mandate they should have in each asset classes, by the way. But when it comes to Spear, we can go from 0 to 100 in any other classes. So dynamically we'll be shifting. So your wealth creation will be taking place without the kind of not deteriorating your opportunity cost. So as when it comes to multi-asset, other PM mutual funds, they have short-term performance pressure as due to the industry mandate. When it comes to Spear, we are focused only on the long-term value creation for the clients. As we are more contrarian based, where we can see most of the multi-asset funds are more consensus based, by the way. And the thing is that the portfolio construction, when it comes to the mutual funds, they are more standardized. They follow a modern portfolio theme where we are more customized. So the person who starts pure PMS today, based on today's opportunity, the portfolio will be constructed. A person who is joined like a week back, based on the particular opportunity during that particular market time, the portfolio will be constructed. So it is more dynamic, and in the long run, everything will be aligned towards this multi-asset dynamic nature. As when it comes to the exit, by the way, it will have only impact in the individual level. And taxation, as when it comes to mutual funds, they are in the now when the redemption takes place, you'll have tax impact in that. Where in Spear, each asset class has a different kind of taxation level. Well, so to start investing in the Spear, by the way, the minimum investment is 50 lakhs, which is as per SEBI mandated. And the benchmark what we follow for Spear is the multi-asset index, by the way. So the thing about this index is that this index is constructed with 50% of NSE 500, followed by 40% of Nifty 50 arbitrage and 10% of return inward. Where in Spear, we don't have any exit load, by the way. And fees, when it comes to the thing, it's 1.5%, by the way, which will be charged on a quarterly basis, which is 1.5% per annum, which will be charged on a quarterly basis. So the horizon of investment, what we expect from investors is to stay invested for the period of 5 to 7 years to see a good ideal growth in their portfolio. As we don't have any cap, we can go from 0 to 100 in any asset classes, where in a single stock exposure, as a total of your particular client now, it will be not more than 25%. Well, this is a team from our ithought. So Shyam sir will be our fund manager, and the following is the team. We manage the products Sphere and new and other PMS products. So yes, thank you everyone. We can meet in the next upcoming webinar. Thank you guys. Thank you for your time.